Assalamualaikum warahmatullahi wabarakatuh. Shalom, Om Swastiastu, Namo Buddhaya, dan salam kebajikan. Hello, we are from Group 4 and we will presenting about predictive approach, positive approach, earnings smoothing, and earnings management. Next slide is the group members. Okay, so these are the group members.
Next, we will talk about income smoothing. Income smoothing is a practice in which company management arrange the timing of revenue and expense recognition so that reported profits appear stable or consistent from period to period. The goal is not to falsify data, but to reduce profit fluctuation to make them look normal, increasing the positive perception of investors and stakeholders towards the company's performance. Gordon's proposition on income smoothing, economist and accounting expert Leonard Gordon formulated several important positions to explain why management performs income smoothing, especially from the perspective of utility or welfare personal interest of management. And now, proposition on income smoothing. The first one, criteria for selection or accounting principle by management. Management chooses accounting principle based on the goal of maximizing its utility. This means that accounting policies are not chosen neutrally or technically, but based on what is most beneficial to management's position and interest. The second one, factors that increase management utility. According to Gordon, there are three main things that increase management utility. The first, job security. If the financial statements look stable and good, managers are less likely to be replaced or criticized. And the second, salary increase and bonus. Stable and growing profits over time can encourage an increase in the management income because the company's performance looks good. The third, company size growth. Companies that grow large trend to increase management influence and position in the market or organization, which also increase their utility. And the third, from the proposition income smoothing, achievement of management goals depends on shareholder satisfaction. Management success in achieving the three goals above depends largely on shareholders' satisfaction with the company's performance. This means that management's interests are greatly influenced by how shareholders assess financial statements. If shareholders are satisfied, and they tend to not push for management changes, agree to strategic policies, and increase incentive for management. And the last one, shareholder satisfaction depends on profit growth. Shareholders tend to be satisfied if they see positive and stable growth in the company's profit. Therefore, management has an incentive to do income smoothing so that profits appear to continue to grow, even though in reality they may fluctuate, so that stock price remains stable or increase.
Gordon's theorem explains that companies that manage to maintain stable earnings over time will be more predictable to investors and analysts. When earnings are stable, the risk perceived by investors becomes lower. This can increase market confidence and even lower the company's cost of capital. This theory is the basis of the practice of income smoothing. There are various reasons why management may choose to engage in income smoothing. For the first, to reduce perceived risks among investors, stable and predictable earnings are often viewed as more reliable and less risky, which can enhance investor confidence. The second is to strengthen relationships with creditors. Consistent financial performance helps build trust with lenders, making it easier for companies to secure funding. The third is to positively influence the market's perception of the company. Fluctuating earnings may lead to uncertainty, which can negatively impact stock prices. By smoothing income, management aims to project financial stability. And the fourth is to optimize performance-based incentives. In some compensation agreements, bonuses are tied to profit thresholds. Maintaining steady earnings can help ensure those targets are met.
Constraints leading to income smoothing. The first one, the competitive market mechanism. This refers to the pressure that companies face to perform well in a competitive industry. If a company reports very volatile earnings, it might look unstable compared to competitors. So management may try to smooth income, making profits appear more stable. So that investors and creditors see the company as reliable, the company's stock price is less likely to fluctuate wildly, and the last one, the firm appears to be managing operation efficiently even during the tough times. For example, if one year the company earns a very high profit, they might defer recognize some income to the next year to keep earnings steady. The second one, the management compensation scheme. Many managers receive bonuses or stock option based on the company's earnings. If earnings go too high, the firm might not want to pay very large bonuses. If they are too low, the manager might get nothing. This creates an incentive for manager to smooth income. First, to stay within a target range that gives them optimal bonuses, and the last one to avoid triggering penalties of reviews if earnings are too low. For example, if earnings are just below the bonus threshold, management may accelerate revenue recognition to qualify for a bonus. The last one, the number 3, the threat of management displacement. This means the risk that manager will be fired or replaced if the company performs poorly. To reduce this threat, managers may smooth income to avoid showing sharp drops in profit, which could make them look incompetent or raise concern among shareholders in the board. For example, if a year looks particularly bad, management may delay recognizing certain expenses or losses to make the financial look better and avoid getting fired. Dimensions of income smoothing. The first one, smoothing through events, occurrence, and or recognition. This dimension involves controlling when revenue or expenses are recognized in the financial statements. Events occurrence is managing when a transaction or event actually happens, and events recognition is adjusting the timing of when the event is recorded in the books even if it already occurred. The purpose is to make income appear more stable by moving revenue or expenses between periods. The second one, smoothing through allocation over time. This involves spreading certain costs or revenue over multiple periods rather than recognizing them all at once. And the purpose is to avoid large spikes or drops by income by allocating the impact of certain items gradually over time. And the last one is smoothing through classification. This step involves changing how items are categorized in the financial statements to affect how income is presented. The purpose is to present core operating earnings as smooth and stable, even if total net income might fluctuate.
So I will explain about accounting choice. The choice of accounting method is often influenced by management incentive, especially those related to bonus, debt contract, and political pressure. In this context, there are three main hypotheses that explain managers' behavior in choosing accounting methods. First is bonus plan hypothesis. This hypothesis states that managers of companies that have bonus schemes will tend to choose accounting methods that increase current period profits. The goal is clear: with profit that look high, they can get a bigger bonus.
Next, for accounting choice is debt or equity hypothesis. This hypothesis states the companies with a high debt to equity ratio will tend to choose accounting methods that increase earnings to avoid breach of debt contract, confines creditor that the company is able to pay obligation. The higher the debt, the greater the incentive to decorate the financial statement to keep them looking healthy. Next is political cost hypothesis. This hypothesis states that large companies that have high profit will tend to reduce report profit to avoid government and public security and avoid additional regulation or tax.
Okay, now I will explain the accounting paradigm. So there are seven accounting paradigm. First is anthropological paradigm. This paradigm sees accounting as a part of culture and human behavior in society. Is studied in a social and cultural context, paying attention to how values, norms, and custom influence accounting practice. Second is behavior of the market paradigm. This paradigm focus on market behavior and how accounting information affect the decision of market participants such as investors and creditors. The third is economic event paradigm. This paradigm views accounting as a system of recording and reporting economic events that affect the financial position of an entity. The fourth are decision process paradigm. This paradigm places accounting as a tool in the process of making economic decision, both by internal management and external practice. And the fifth is ideal income paradigm. This paradigm discusses the concept of ideal income, namely how income should be measured and recognized in financial statement to reflect actual economic performance. The sixth is information economic paradigm. This paradigm highlights the role of accounting information as an economic commodity, emphasizing the importance of relevancy and reliability information for user financial statement. And the last for this accounting paradigm are user behavior paradigm. This paradigm focuses on the behavior of user of accounting information such as investor, managers, and regulators and how they utilize information. So that's all the material presented by us. Thank you for your attention and wassalamualaikum warahmatullahi wabarakatuh.